All right. I want to thank everyone for joining us this afternoon. This is our mid-year market update. I was joking with a client the other day, and I said, sometimes volatile markets or down markets are a little more interesting than up markets, but year to date, it's been quite a soap opera, particularly over the last 3 months if we think about how the market dynamics have changed. So today, what we're going to do is touch on where the markets have been this year, and then also look at some headwinds and tailwinds as we approach or kind of dive into the last part of the year, last 6 months of the year. I want to introduce who is on the webinar with us today. We've got Brian Burton, our Chief Investment Officer and Portfolio Manager, Andy Reynolds, Partner and COO, and Cameron Hamilton, Partner and Director of Financial Planning. I should have mentioned Brian's a partner as well. So with that, let's just hand it to Brian. If you want to get started, we've got some slides to kind of create the agenda for this call.
Perfect. Thanks, John. So it has certainly been a wild ride, like you said, to say the least, to start this year, both in news headlines and in markets. So we can start with what's likely been the hottest topic of the year to date, which is tariffs. We had, if you recall, we had sweeping tariffs announced back on April 2nd. And the S&P proceeded to drop by 12% in the week following. Volatility, as measured by VIX, spiked to levels that we hadn't seen since the pandemic. And yet, we sit today, we've completely rebounded markets into positive territory year to date. So quite resolve that we've seen in the markets. So it kind of brings up the question that I'll open up to the panel here. So why do we think that markets have been able to shrug off the fear of tariffs and perform so well, even in the face of more newly announced tariffs?
I can jump into that first. I think one, that's a very simple question with a very difficult answer. I think there are a lot of things going on with the tariffs. As you know, that was the bulk of our conversation last time we did one of these videos. It was it's Brian, you, and John, and myself in the middle of really what was going on there. I think big picture, a handful of things are at play. I think we keep moving the goalposts. So, what the tariffs will end up actually looking like, if we'll have tariffs, what tariffs will stick, what tariffs won't stick. I think there's a lot of just unknown. Obviously, delaying the tariffs have helped. I think we're seeing a handful of good news from corporations as well, being able to navigate these tariffs and supply chains that they're able to change to. I think also with the tariffs, there's a bit of just uncertainty that has caused just an exhaustion almost with some of these, companies and investors and whatnot. That some of the, we'll talk about geopolitical in a little bit, but just a bit of trying to move past it and just trying to figure out how they can continue managing their business, running their business, even knowing that we have all this uncertainty still ahead of us.
Yeah, exactly. And it's amazing markets have reacted the way they have, given all the uncertainty. You look down this list of, we did see the market correct, I think nearly 20% from peak to trough in just a short bit of April there, quickly rebounding. We had still the continuing conflicts in the Middle East. We've seen some attempts there at diplomacy, some peace talks there, but tensions still remain elevated. Markets still concerned how that will play out. There's been this narrative too about the end of U.S. exceptionalism that's been pretty prominent through the first half of this year. How do you all think about U.S. exceptionalism? Is this narrative something that we should all be concerned about as investors?
Well, I mean, just going back to the tariff conversation, sort of how it impacted the conversation around U.S. exceptionalism. If you remember in the few days following the Liberation Day and the announcements around tariffs, I think there were a lot of questions is like, is this the new paradigm that we're going to be living in, at least for the next, 4 years, where we have essentially where we're closing off our borders, so to speak, and we're trying to do everything ourselves, if you want to simplify it. And I think that terrified the markets. I mean, the reaction would tell you that companies were not prepared for that. Our consumers were not prepared for that. We were going to face rampant inflation due to that playing itself out in a quick way. And then between the 90-day pause and some of the negotiation and just sort of the haphazard way that a lot of the tariffs have been proposed, I think there is just a general consensus now that this is a negotiation tactic, and whatever we end up in, I don't think anybody exactly knows, but it's probably not going to be at these extreme tariff rates that are being proposed if you just kind of follow the negotiations with some of these countries. And then added to that, still showing, where the U.S., from a military standpoint, from a security standpoint, from an asset standpoint, when I think of security and where investors are placing money, U.S. assets are still deemed safest. U.S. Treasuries, although rates have gone up, still deemed the safest. And we are the technological innovator of the world still today. So I think some of that narrative sort of washing off post-tariff announcement is why you've seen the market sort of recover, which has been pretty remarkable if you consider sort of the the polarizing president we have right now. And we have half of our consumer base right now who doesn't really like what's going on, and the other half that does. That's a pretty wild backdrop.
I'll just add for the U.S. exceptionalism. I was just thinking about this as you're talking, John. With I was thinking about like flying in like the airline industry, and we get caught up on when things don't go well, and we get caught up on things. You give a delayed flight, or you have turbulence. You tell everybody about it, and I think we're seeing a lot of that with the U.S. right now. Like we're not perfect. We have things that we need to fix, and we will fix those things. But there are a lot of things that are going really well as well. So I think we get so much of the narrative caught up on the things that are bad, scary, or potential issues that we struggle fixing. And sometimes we don't always highlight all the positive news as well.
Without a doubt. Great point, Andy. So that leads us to the next the point to talk about, which is the AI trade. So over the last, call it 2.5 years, the AI trade has been the number one theme in the investment landscape. Best performing, and a lot of that's concentrated in the mega cap names in the S&P 500. So you've seen a lot of capex dollars going into AI infrastructure build outs, what have you. What we saw in April during the sell-off was interesting. These names in this AI basket, if you will, sold off the hardest during that period. In fact, it was crushed, following a couple great years of performance, no doubt. So there was talk during that time of potentially this being the unraveling of this AI trade, the end of it potentially. So since then, those names have rebounded rapidly to back to, you've got Nvidia now at all-time highs. Some of your bigger players in that space are now traded higher than they've traded ever. So do you think that period in April do you look at this more of just like a high beta trade, so names that are going to react and sell off harder than the overall market during periods of volatility? Or do you think there's more to the theme of this AI trade maybe coming to an end?
I'm happy to hop in there for a minute. And I don't see the theme changing at all personally. I've been telling people for 2 years a couple big stories are going to be AI and interest rates in the Fed. And I see that being two major themes for the next year. If the AI trade was over and this was just a high beta trade, I feel like you'd want to see the Mag 7 behaving all the same. But we're seeing differential performance in a big way this year. So if you look at Google, they've been majorly challenged this year, right? So they get their money from having ownership of search. I know they've got a little bit of monopoly questions out there, but it's all about search and serving ads and having the best business model in the history of the planet up until the last couple of years. But that's majorly at threat if AI soaks up all the question asking that we do and we don't go do it in a Google browser. So they're getting punished for it. And then Apple, they actually produce a consumer product that's a physical thing that has to get made mostly in China. And there was that period where we saw them airlifting all this inventory and trying to create capacity in India. So, there's that's not a pure AI play there. They don't have as much of a discernible strategy there. So they're not trading with Meta, Nvidia, Facebook. So that tells me that this theme is going to continue and it's going to dictate winners and losers in the short term, just like it has over the last couple of years.
Yeah, I mean, I think AI is here to stay. I think the questions around the companies where the spend is right now, like Nvidia being the prime example there, I think that's going to continue. I mean, I just think, there is a lot of concentration of, well, handful of very large customers, supplying most of Nvidia's revenue right now. And I think the story around that is going to continue. And this is so reminiscent to the beginnings of the internet. It probably, you could argue it's the most disruptive technology since internet was introduced and internet commerce was being adopted. And at that time, if you think about who the initial winners were, you had the Amazons of the world, which are still the winners today, but you also had some winners that are not winners today that maybe don't even exist as companies. So I think there are so many chapters to play out in this space. And I think over the next couple of years, what will take a greater focus, it will be less about infrastructure. It will be more about what are the other companies in the S&P 500 and new startup companies, how are they utilizing AI to create new industry, to outcompete. Right now we're still in the build out phase. I mean, it's a very usable technology. I mean, we all use it on a regular basis. We're all AI characters right now, right? No one realizes that. We're not even on here live. But no, I mean, we've used it to, I mean, I had a commentary that Madeline asked us to write for a piece, and I put it in the chat GPT and I said, shrink it by 50 words and within 5 seconds. I mean, it's a very usable tool right now. But I think, monetization of the technology is still a question, and who the long-term winners, I think, is still a question.
Yeah, and it's such an important theme going forward in markets. You think about the kind of the breakdown, the sector allocation of the S&P 500, and what percentage of that is in tech, and how much of that uses AI. Tech's 31% of the S&P 500. So, this theme is very important for the index as a whole, not only us as individual investors. So,
And as investors, I think identifying that correctly is going to make winners and losers. So, we talked about that recovery, and 50% of the large cap growth gain came from the four names. It came from Microsoft, Nvidia, Meta, and Netflix. So we are starting to see more differentiation. Just going back to Cam, your point, and putting numbers behind it, we're starting to see the differentiation of that. And just because it did well over the past 3 months may not mean in 3 months from now that those are the winners, because it's changing so quickly. And as soon as something's developed, it feels like everybody's jumping and getting there. And then, who takes the next step forward is really challenging to understand and to predict with significant accuracy.
Yeah, so I mean, all of this wide range of economic and market developments that we've seen in the first half of 2025, they've created this sort of wall of worry for investors. And what we've seen over time is that equity markets are great at climbing walls of worry. And what's happened in the first half of the year is that investors who have stayed the course and have maintained diversified portfolios have been rewarded. You ride out the volatility, and now you should have, most investors should have positive returns year to date. So let's move on to some of the headwinds and tailwinds that we see in the back half of this year and moving forward. Oh, first thing to note is that the U.S. economy as a whole appears to be rather healthy. We did have a negative GDP print in Q1, but that was mostly due to demand being pulled forward, inventories being built up to try to get ahead of tariffs. That was the majority of the negative growth for the first quarter. The job market, unemployment rate still incredibly low. The consumer as a whole on aggregate appears to be healthy, and growth forecasts for U.S. corporations are still in the double digits range year over year. So a healthy economy, we're looking for whether or not the Fed will begin a rate cutting cycle in September. It's almost 50-50 right now in betting markets if that will kick off in September. 25 to 50 basis points are baked into the market at this point. What I think is important is if markets just see that cycle get started. It's not about, is it one cut, is it two cuts? It's just getting that easing policy started. And I think markets will react with a lot of cheer if they see that process get started. Another positive is that the bar for this earnings season is pretty low. That's a function of tariffs. Like I mentioned, a lot of companies building up inventory. So we could potentially see some margin improvement in Q2 numbers. So we had the BBB just get passed. So it's pretty stimulative fiscal policy. And what we cheered on there is that we didn't see a spike in interest rates. And in fact, markets are still pricing in a decrease in the 10-year Treasury, which could have easily gone the other way. Inflation numbers, still modest inflation in the 2.5 range. The numbers we saw today were pretty much as anticipated. I think the interesting thing there is that we really haven't seen a ton of the tariff inflation play out. So that theme hasn't exactly played out. Now it's still early, no doubt. But overall inflation appears to be coming down, trending downward still. And as I mentioned, on aggregate, not everywhere, not all consumers for sure, but as the data shows, consumers as a whole are still spending, still spurring the economic growth there. So I'm going to open it up to the panel to see if you all have any comments or thoughts on any of those.
I mean, I think there's going back to the first slide and then thinking about this, there's so much interconnectivity between all of this. And, inflation had been the largest concern, and I think it's largely taken a back seat as we've seen CPI come down. And if you think about stimulative fiscal policy, the Fed likely to start cutting rates in September, both of those could stimulate inflation. But there could be one really nice thing sitting out there, and that's AI that could actually help keep inflation down. I mean, a lot of people don't think about technology and how it impacts inflation, but if you look at history and you look at particularly over the last 25 years, you will note that technological innovation that causes productivity gains in individuals, that really allows companies to do more with fewer people, keeps wage inflation down, which we all know is a big tailwind for overall inflation. So AI may be the thing that's actually sitting out there as sort of a long-term, sort of paradigm aspect that could help keep inflation under wraps. I mean, if you want to look at it from an optimistic tailwind standpoint, there are issues that come with that, obviously employment issues and others, and a lot of disruption. But it was just something I've been thinking about.
No, I'd agree with that. And, with the AI comment, I actually just used AI while we're doing this. One other part on here that we haven't talked about yet, a lot of people are talking about is cash on the sidelines as well. So, you know, according to Google AI, um, about 7 trillion in cash staying on the sidelines potentially, and potentially up to 18 trillion if you count cash in consumers' pockets as well. So, what happens with that if things start to look better from a from an even further tailwind standpoint of lower rates, and if we see a little bit of fiscal stimulus with understanding where the taxes are and having that bill done now, not at the end of the year. So I do think, again, getting back to that comment of there's still a lot of good things going on in the economy and consumers. We're a consumption-based economy and consumers are still spending. Maybe we'll talk about it in a little bit of how it's changing, and maybe there's a have and have not of consumers. But so far there's still a lot of positives in the economy from across the board when you're looking at all this stuff.
Before we get there, just a comment on the cash on the sideline and rates. We have a lot of clients with cash sitting on the sideline and treasuries just because they've still been getting a pretty good rate, just around 4% at a year. And I've personally bought a lot of treasuries for people who maybe they're installing into the market, or maybe they had a one-time influx that we didn't want to put to work all together. And they're micro examples of a big macro trend that's going to happen. If rates come down, that's going to flow into equities to a certain extent and be hugely a tailwind there.
Yeah, what's been interesting to me about this rally is that it's been very much an unloved rally, in the fact that investor positioning, particularly at the institutional level, they've not been as long or taking on as much risk as they would have liked. If you look at it on a scale of 1 to 10, they're positioned around a four or five on the risk scale right now, and throughout this recent rally. So that brings up an interesting question of, how are we at or near all-time highs with all of this cash on the sidelines? What's really interesting now, the structure of passive flows that go into the market naturally. We're looking at $1 trillion annually right now of corporate buybacks. So, you've got money flowing into markets completely agnostic of what's going on in the economy. Those are set, those are scheduled, those are happening. You've also got $200 billion of passive 401k buying that happens regardless of what's going on in markets. So, stock market today has this natural kind of uptick to it structurally, which is pretty fascinating.
I think it's almost safe to say we have one of the most resilient markets that we've had of all time. And, I just made a note of these things that were post-pandemic. So elevated inflation, high rates, regional banking stress, geopolitical issues, global trade tensions, tariffs. And largely in the face of all that, the market's been super resilient. And I do wonder, not to go on a tangent, but I do wonder if part of it is, we get so much information that we somewhat become numb to it. But at the same time, we get so much information that we all, as a population, understand investing better than we did 20 years ago, 30 years ago. And maybe there are less pressures to overreact to all these things that may have less long-term impacts. And we just have a more educated populace and population of people making these decisions of buy, sell, and maybe the overreactions are more muted than they have been in the past.
I've been coining a new term with my clients, just talking about almost perverse discipline that's been created just with the inundation of news stories. I feel like there's almost 20 things this year that could have caused a 5% down day in the market, of ideas that have been shared that were opportunities to overreact to. And we talked some of the geopolitical stuff that's happened. And it's almost like we're just fatigued into a discipline, not because necessarily we're so much better disciplined investors like we've been and treating people to be for the last 15 years, but that just because they've realized we can't react to every single thing.
Well,
I'm
I
interested
think
to see if that continues outside of this administration.
Andy, to your point about resiliency, it's a really good one, and it's market resiliency, but it's also corporate resiliency. I mean, I was looking back at earnings pre-COVID. 2019 S&P 500 earnings were like 175 bucks in aggregate, and if you look at 2025 and 2026 projections, we're getting into the mid 250s, around $300 in 2026, and some even higher than that. So, what it shows is that U.S. corporations have been remarkably strong at navigating these just various crises as they've occurred. And obviously we had a dip during COVID, but a quick bounce back in 2021 to follow.
Yeah, so we've painted a pretty healthy, rosy picture for markets moving forward, and a lot of reason for doing so. Definitely a lot going on, good for market positioning and sentiment. So, but let's turn and face the other side of the coin, which are some of the headwinds that we see going forward. So let's start with the thought here is if the Fed continues what's called restrictive policy or not loosening policy by lowering rates, that economic growth will be suppressed. That's a potential if we don't see that. Bring the Fed start that cycle of bringing down rates. We also saw breadth in the market, so participation among companies re-narrow again in Q2 around a select few names. We talked about the AI trade in particular, which is not great for diversified investors in large cap stocks. Most of the performance came from just a handful of names, which we had seen that breadth kind of broaden out in Q1, and hopeful that would that theme would continue. But we did see a reversal of that in Q2. We mentioned geopolitical tensions that remain elevated. Market looks on a historical basis expensive. I think we're trading around 21 times forward 12-month earnings. Consumer credit. So we talked about the health of consumers a little bit, but we're going to touch, kind of double click on that here when we talk about consumer credit delinquency has been on the rise as of late. And then just policy uncertainty, that it makes it difficult for consumers, makes it difficult for businesses to even forecast the next quarter, if you will. So I'm going to open it up again to the panel to kind of talk about some of the headwinds that we see going forward.
I'll hop in. I love following the consumer side of things. I'm interested in that. And I think we're a consumption-based economy. We have to be able to continue consuming more, and be able to afford to continue to consume more and not drive ourselves into significant debt doing so. So it's something we look at. We pulled up this 90-day delinquency chart multiple times. I don't think there's anything blinking red right now, right, of the consumers, but the trend is starting to show maybe some cracks in the consumer data. If you look at the past 2.5, 3-year trend on credit card delinquencies, 90-day delinquencies, and then other date delinquencies, it's pretty much moving upwards to the right at a pretty good clip, nearing where we were back in the financial crisis. And I think also on the flip side of that, though, if you look at one chart that I always follow, which is household debt service payments as a percentage of disposable income, which to me feels like, okay, how much of this debt can I afford out of my monthly income? That's near all-time lows. So going back to the earlier comment, I do question and just wonder if this separation of haves and have-nots is continuing to grow, and the middle class, which is really what built this country and economy, if it continues to shrink. And I know we had a question about, AI and jobs, if anyone wants to touch on that, that's obviously a headwind as well. Personally, I think there'll be new jobs that are created by AI, but that's obviously a headwind of what happens to the jobs that are replaced, just like, when factories came in and the internet came in. I think all those are real headwinds to think through.
I like to think about these headwinds short term and long term. I think short term, to Andy's point, the consumer, is the consumer going to continue to be as resilient as it has been? There was a data point that came out right after the tariff announcements where airline bookings for the 4 or 5 days following that announcement were down, I think 5 to 6%, just based on the headline. So that tells you very clearly that the consumer, and that's an important part of the consumer base, right? These are people with discretionary income, the ability to book a vacation, book a flight, that they were reacting conservatively to that. So political tensions grow, geopolitical tensions grow, not great for the consumer strength. And you would see that flow through the economy. So that's a concern. And just based on the political divide that we have in the country right now, I don't see that washing off anytime soon. So that I think there is going to be, depending on the headline of the day, a certain group of individuals that are going to react a certain way to it. Long term, the biggest headwind, and we've heard about it a lot through BBB and this proposal, and obviously the fights between Elon Musk and Donald Trump, is the debt and the deficit. At some point, we are going to have to face this issue, and how that's going to be addressed. There's really only two ways. Either we raise taxes or we cut government spending to get our fiscal balance back in order. Both of those are headwinds and big headwinds for economic growth. So it does not appear that those are going to be addressed in this bill or in this likely during this presidency. But at some point, political leaders are going to have to face the issue. And I think if I'm thinking long-term headwinds, that's one that troubles me.
I think so. And just to double down on that, like when I look at, okay, consumers get stretched, they slow down spending, the economy slows down, we deal with that, and the economy booms and busts, like that happens. The debt thing is, you look at your young kids and grandkids, and that's something that in their generation, more likely than not, is gonna have to be dealt with. And the longer it goes, the less fun it's gonna be.
And we talk about the interconnectedness of all these topics. We talked about American exceptionalism, and looking back over the COVID period, empirically, we proved ourselves to be most capable of printing money without causing extreme inflation. Even though we had it, we did better than the other developed countries. But to the extent that we stand out from the crowd with how much debt we're creating, that's going to be tested. And also to the extent that the concept of us being the global market and the reserve currency gets challenged. That's where we start to really get in a risky position. And we think about that playing into the tariff conversation this year. And are we going to be providing chips to China that Nvidia said we can't be given as good of chips, and so now we say, are we waking up a sleeping giant and creating a space race and getting China really motivated to be the platform for this new technology? Now, over the last couple of days, it looks like we've come back on that concept, and I don't think those two things are unrelated at all. I think we got to be careful how far we stand out from the crowd, lest that gets tested.
We do have a question that's come in. How will AI affect jobs for people? Anybody want to touch on that?
I'll give us as an example. John, your note taker is on this call. So, we're in the knowledge economy, and broadly, the US is more in the knowledge economy than it's ever been in its history as compared to, production and manufacturing economy. So it extends all these people who are already out in the market and makes them more efficient and effective. And that's great for us, and that's great for our business, and that's great for all these publicly traded companies that are trying to do more with less, like we mentioned on this call. The short-term challenge that I see is entry-level jobs just not manifesting like they have with each successive cohort that's come out. The tasks that interns used to do that afforded them the seat on the boat to get in and learn and be a knowledge worker who could take advantage of the tools of AI. That concept is getting challenged. And when you see Microsoft laying off big parts of the HR department, but hiring in the engineering department, they're saying we're trying to bet on things that create new revenue and starting to see some of those individual humans as costs. So, my advice for people graduating or getting out of high school or college and trying to think about this job market is you have to be more laser focused on your value than anyone else before you. I feel like every 18-year-old always looks back and said, wow, my parents had it so good. They bought that house for $15 back in the day. And our clients who have these kids will say, yeah, but I did it on a 15% interest rate. That debate is evergreen, but I don't envy the people coming out of college who are trying to get their first job at the same time all the other companies are saying, maybe we could just do without interns and these lower rung task doers.
I do think there'll be new jobs created that we
Yeah.
haven't even envisioned. If you just look at our business as an example, Brian does the majority of the trading. For the amount of trading we do nowadays, you go back 25 years ago, that would have taken probably multiple people. You look at the software we have that identifies planning opportunities, that identifies tax opportunities. A financial planner in an investment company like ours 25 years ago probably didn't really exist, and now because of technology we've been able to create new jobs and do a better job for our clients. So I'm optimistic about it. It won't be a smooth ride. It'll be bumpy. Obviously if robots take over the world, there's nothing we can do about that. We're all in trouble. But I do think there'll be new opportunities and new jobs and things we don't think about, and then all of a sudden it's like, hey, yeah, that's a no-brainer. And so I'm optimistic about it. I think we'll have new opportunities. But with that, just waking up and graduating high school and working on the factory line, those jobs may not exist, and it may take more creativity and ingenuity.
There's a term, it was coined in the 1940s, economist Joseph Schumpeter, I believe, who coined the term creative destruction, with the idea that, economic growth and progress happens from disrupting existing industry and new industry being created and new technology being created. And you'd be hard pressed to look back at the history of both the US and other developed countries and point to technological innovation that has led to excessive job loss to follow. Typically, to Andy's point, opportunity is created by that. Now it's opportunity that we can't necessarily see clearly today, but if history repeats itself in any semblance of what it's looked like in the past, you will see new industry, new job opportunities created. And to Cameron's point, for a young person coming up, it does create challenges because what you thought that career path may look like, you just may have to be a little bit more nimble and accepting of sort of the world that's in front of you and the opportunities that will exist. And I think those people that are willing to retool and refocus and take the opportunities, I think will do great. But stubborn, stubborn towards a certain path, I think could be challenging for many.
Yep.
So I think we're going to go ahead and wrap it up. Want to thank everybody for attending this webinar. Would love any feedback you have, and of course, if any questions that you have following this that we didn't address on today's talk, we'd be more than happy to talk to you about it. And we will be recording this, or are recording this, I should say, and we're going to post it to the website and distribute it. So if you didn't get a chance to watch the whole thing, you'll get the chance to in a few days. So thank you all for attending. We appreciate it.